Every paycheck, your employer is trying to give you a guaranteed 50 to 100% return. But if you're like most Americans, you're leaving that money behind. Stay until the end where I answer the 3 most common questions about this. The free money pass. Most Americans walk past free money every single paycheck. Not because they cannot afford it, but because nobody told them the exact percentage required to trigger it. The money was always there. Nobody ever pointed to it. The guaranteed return. The 401k employer match is the only return in personal finance guaranteed before any market risk is taken. A 50% match is a guaranteed 50% return on day 1 before a single dollar enters the market. The pay cut hidden. Failing to capture the full employer match is not missing a bonus. It is accepting a permanent pay cut every single paycheck. Your employer already budgeted that money for you. You are quietly being paid less than you were offered. The enrollment trap. Many companies auto-enroll employees at 3%, deliberately below the match threshold. If the full match requires 6%, half of it has been unclaimed since your very first paycheck. Check your rate today. The awareness gap. Most Americans with an employer match know it exists, but not the exact threshold required to claim it. That single gap between knowing and knowing the number costs thousands every year. The number matters more than the knowledge. The career calculation. The average American changes jobs 12 times over a career. Every role where the match went unclaimed is compensation your employer budgeted, set aside, and never paid out. It expired quietly every 2 weeks for as long as you worked there. The time multiplier. An unclaimed match is not just money lost today, it is money lost compounded. A $2,000 annual unclaimed match growing at 7% for 30 years is over $200,000 of retirement wealth, offered, declined, and gone for good. The debt priority trap. Many employees skip the match to pay off debt faster, but a 100% match up to 5% of salary is a guaranteed 100% return. Almost no debt's interest rate beats that. The match always comes first. The salary context. The employer match is not generosity. It is compensation already priced into the budget. Not claiming it is the same as negotiating a raise and then declining it every single paycheck it arrives. The beginner priority. Before index funds, before a Roth IRA, before anything else, the 401k up to the match threshold is the first move every employed American needs to make. It is the only guaranteed return that requires nothing but a percentage adjustment. Question number 1. What exactly is the employer match? How does it work? And what do I need to do to get it? The match formula. Most employer matches follow a simple formula, a percentage of your contribution up to a cap. The most common structure is 50% up to 6% of salary, meaning 6% from you earns 3% free every single paycheck. The dollar for dollar, some employers offer a true dollar for dollar match. Contribute 5% to a 100% match, and your total retirement contribution is 10%, half from you, half completely free. It is the single most valuable benefit most employers offer. The threshold number. Every match has a threshold, the exact percentage required to capture all of it. Most employees know the match exists, but never ask for that one number. Your HR department or benefits portal will tell you in seconds. The pre-tax advantage. Traditional 401k contributions are pre-tax, reducing your taxable income by every dollar contributed. In the 22% bracket, $200 per paycheck costs you only about $156 in real take-home pay, while the full $200 plus the employer match goes to work. The Roth 401k option. Many employers now offer a Roth 401k alongside the traditional option. Roth contributions use after-tax dollars and grow completely tax-free, though by law, every employer match dollar still lands in a traditional account, regardless of which one you choose. The annual contribution limit. In 2026, the employee 401k contribution limit is $24,500 a year, $32,500 if you are 50 or older. The employer match does not count toward that limit. Every match dollar is added completely on top of whatever you contribute. The investment menu. Your employer selects the menu of funds available inside the 401k, typically mutual funds and target date funds. Your match flows into whichever funds you choose. Most beginners pick a target date fund or the lowest cost index fund on the menu. The automatic enrollment. Many employers auto-enroll new hires at a default rate, commonly 3%. That is better than nothing, but it is frequently below the match threshold. Always confirm your automatic rate actually captures the full match from day one. The pay period math. The employer match is calculated and deposited every pay period, not as one annual lump sum. Fall below the threshold for even one paycheck, and that period's match is gone for good. Consistency from day one captures every dollar. The total compensation view. Always calculate total compensation, including the match, when evaluating a job offer. A $70,000 salary with a 6% dollar-for-dollar match is $74,200 in real compensation. A $72,000 salary with no match is actually worth less. Question number 2. What are the vesting rules, traps, and things most employees never know about their match? The vesting schedule. Employer match dollars are almost never immediately yours. Vesting schedules decide when the match legally becomes yours. Cliff vesting all at once, graded vesting gradually. Leave before fully vested, and the unclaimed portion disappears permanently. The cliff vesting trap. A 3-year cliff vesting schedule pays you 0 match dollars if you leave even 1 day before the cliff date. Even after 2 years and 11 months of contributing, the match shows in your balance. It legally belongs to your employer until that date passes. The graded vesting schedule. Graded vesting releases ownership gradually, commonly 20% per year over 5 years. Year 1, you own 20% of the deposited match. By year 5, you own all of it. Know exactly where you stand before any job change. The true-up problem. Some employers calculate your match on a full year average, not per paycheck. Max out early in the year and stop contributing, and you can lose match deposits for the remaining months. Always check if your plan offers a true-up. The Safe Harbor Plan. A Safe Harbor 401k requires immediate 100% vesting on every employer dollar. No cliff date, no schedule, no forfeiture risk. The match is fully yours the moment it lands, no matter when you leave. The match cap. Every match has a cap, the maximum your employer will contribute no matter how much more you put in. Contributing above the cap still benefits you through your own tax-deferred growth. It simply stops earning extra employer dollars. The job change risk. Leave a job with unvested match dollars and the forfeited amount returns to your employer, not to you. Know precisely how much unvested match you would lose before accepting or leaving any role, especially in your first few years. The rollover requirement. When you leave, roll your full vested balance, including every match dollar already earned, into an IRA or new 401k tax-free. Cash it out instead and you trigger ordinary income tax plus a 10% early withdrawal penalty. The small business difference. Small business plans sometimes use simple IRAs or SEP IRAs with entirely different match formulas and vesting rules. If you work for a small employer, always confirm your exact plan type before assuming standard 401k rules apply. The contribution timing. Irregular or lump sum contributions can cause missed match deposits in pay periods that fall below the threshold. A consistent per paycheck percentage at or above the threshold is the only way to capture every match dollar all year. Question number 3. How do I calculate my match, set my contribution, and make sure I never miss a dollar of it? The HR conversation. The most important financial conversation most employed Americans never have is 2 questions to HR. What is our match formula, and what percentage triggers the full amount? HR can answer both in under 60 seconds. Most people never ask. The contribution calculator. Multiply your annual salary by the match threshold percentage, then divide by your number of paychecks. A $60,000 salary with a 6% threshold needs $3,600 a year, about $138 per biweekly paycheck. That is the exact number to enter. The enrollment action. Log into your benefits portal today and update your contribution to at least the match threshold. Do not wait for open enrollment. Most plans allow changes anytime. Every paycheck you delay is a paycheck the full match never triggered. The fund selection. Once your contribution is updated, choose your funds. A low-cost index fund, S&P 500 or total market, is ideal if available. If not, a target date fund matching your retirement year is the simplest default for most beginners. The 1% more. Can't reach the full threshold yet? Increase your contribution by 1% every raise or every January 1st until you get there. The increase is nearly invisible in your paycheck, and it closes the gap within 1 to 3 years. The increase trigger. Every time you get a raise, increase your 401k contribution by that same percentage before your spending adjusts. A 5% raise applied entirely to contributions keeps your take-home pay identical while closing your match gap for free. The account monitor. Check your 401k quarterly to confirm match deposits are appearing as their own line item. Deposit errors happen more often than most people realize and can go unnoticed for months. If a deposit is missing, contact HR immediately. The retirement projection. Run your plan's projection tool twice, once at your current rate, once at the full match threshold. The gap between those two numbers is the exact retirement cost of every year spent below it. That number usually ends the hesitation. The next job negotiation. When evaluating or negotiating a job offer, fight for the match as hard as you fight for salary. A 1% improvement on a $70,000 salary is $700 in guaranteed annual return, compounding tax deferred for decades. Negotiate it like compensation, because it is. Claim what is yours. The employer match was budgeted the day you were hired. It is compensation waiting to be claimed with one adjustment. Every paycheck without it is full hours worked for less than full pay received, and the fix takes 4 minutes. If you found this helpful, consider subscribing to stay updated with our latest videos.